and we're very pleased to facilitate the Fry Group's webinar today. While we're waiting for the last of our attendees to join us, I'm going to run through a few quick housekeeping notes. Today's presentation will last roughly 40 minutes, after which there will be time for questions. All the attendees are muted today, and this is to keep the presentation moving along smoothly. But you may ask questions throughout the webinar by typing them into the questions pane on your screen. At the end of the presentation, we'll have a question and answer session. And if we don't have time to address your question during that time, one of our speakers will follow up with you afterwards, and their contact details will be made available to you during the session. And on to our speakers. Our first speaker, Dean Power, is the Fry Group's UK Tax Technical Manager. He has over 18 years of experience helping clients manage their tax affairs, as well as a wealth of experience. Dean is a fellow of the Federation of Tax Advisors as well. Our second speaker, Alison Lane, is an international financial planner working in the Fry Group's international department. She has been helping clients plan their finances both in the UK and abroad for over 10 years, and Alison has a diploma in financial planning and is a member of the Chartered Insurance Institute. With that, I'm now going to hand over to today's first speaker, Dean Power. It's all yours, Dean.
Thanks ever so much, Sarah. Well, good morning, afternoon or evening, wherever you're listening, and thanks ever so much for logging on today. What we're aiming to provide is a general overview for the expatriate of matters that they should look at when considering their tax situation, whatever stage of life they are at overseas. For those of you not familiar with the Fry Group, we've been established for over 110 years. We've been assisting UK residents with UK tax matters, financial planning and investment advice, and inheritance tax advice, and also the writing of UK wills. Today's webinar does contain an awful lot of information in places, but please don't worry if you miss anything, as at the end of the presentation the slides will be available on our website, and you will be emailed a link to these shortly after the end of the webinar. Do note that what we are about to present is general guidance, and this is of course no substitute for personal advice. Tax and financial planning are very personal, and you are unlikely to find specific answers in the slides. So looking at exactly what the webinar will be doing today, first of all I'll be looking at non-residents, for those who may have just recently left the UK, making sure that your affairs are in order. I'll then be handing over to Alison, and she'll be commenting on expatriate investment. And then finally back to me for matters to consider when returning to the UK, things to review and things to look out for. So starting at the very, very beginning and leaving the UK. And it's at this point that we come to our first poll of the webinar. And for this I'll be handing back to Sarah briefly, who'll be talking you through how that works. Sarah?
Great, thanks Dean. Okay, so our first poll is about to appear on your screen now. And the question is, how long have you lived overseas? So please select the response that most accurately applies to you. That's 0 to 3 years, 4 to 6 years, or 6 years plus. So I'll give you a few seconds to get your votes in. I can see that most of you have voted. Give you a few more seconds. That's great. And I will close the webinar, I will close the poll, in 5, 4, 3, 2, 1. Okay, and the responses are as follows. So we've had 69% of attendees say that they have lived overseas for 6 years plus, 24% say 0 to 3 years, and 7% say 4 to 6 years. Okay?
Thanks for that, Sarah.
Okay.
That's an interesting overview of exactly where people are. As I said, many different stages of living overseas. So starting with the things that you need to be doing to make sure that everything is in order whilst you're living outside of the UK. We'll be looking at the establishment of your resident status and also commenting on the proposed statutory residence test, which is going to be affecting every individual living overseas. We'll also look at the implications of non-residence And finally, some of the paperwork that you should be looking at completing whilst you're overseas, just to make sure that everything is up to date. So starting with resident status as a general point, it is an area that the revenue in the UK are paying much closer attention to at the current time. Previously it had been taken that remaining within the visiting limitations would simply mean that you were non-resident. The problem that we have is that residence is not defined within legislation, and this has led to certain taxpayers simply limiting their time in the UK but maintaining a firm centre of life here. As a result of this, HM Revenue and Customs have updated their own guidance on the subject, and we've also had updated case law which is more suited to the world that we live in today. Consequently, it is more important than ever before to clearly show a break from the UK and a movement of your life from the UK to overseas. Starting with the visiting limitations, which are currently in place at the moment, you would need to ensure that any visits to the UK remain less than 183 days in any one tax year, and also less than 91 days on average, and that's taken over the period of your absence of 4 years, whichever is a shorter. The actual calculation of the time in the UK, since April 2008, any day where you are present in the UK at midnight counts for residency purposes. Before that, we used to have the practice of discounting the day of arrival and departure. That is now gone. But as I say, the number of days that you spend in the UK is simply one factor which is taken into account when you're looking at what your resident status is. So looking at some of the recent case law and what that has established, we can actually read through some of the judgments and come up with one or two firm ideas that we can base people's residence positions on. If you're employed on a full-time basis overseas with no duties in the UK, then if you remain within the limitations that I previously mentioned, then you should be able to treat yourself as non-resident. If it's anything less than that, if you haven't gone overseas or you're not currently employed overseas, then it is a matter of also looking at one or two other factors as well. And some of the things that have been highlighted in case law has included the location of your immediate family, where you have property available for your use in the UK, your business interests, if you continue to perform work in the UK, and also your social connections as well. So this has led to a very, very difficult circumstance in the UK where you have no clarity or no certainty as to how to base your non-resident status. So with this in mind, this is where the proposed statutory residence test comes in. Originally this was intended to be operational from April 2012. There was a consultation document issued last year, and that provided an outline of what the government believed the test would look like. However, following the consultancy period, which the Fry Group contributed to, there were clearly an awful lot of factors that the Revenue hadn't considered, and therefore they delayed its implementation. Last December, we received a response from the Revenue, and they explained that the delay was simply to allow taxpayers and advisors to scrutinise the legislation and detail of the policy well in advance of the implementation in 2013. They then assured us that we would have notification of when a firm publication date of the updated statutory residence test would be published. Now that was supposed to be issued in May. As we're sat here, it's the last day of May. Looking at the consultation documents that have been issued on the Revenue website this morning, there's still no word on that at the moment. It may be that it's still issued today, it may be that it's delayed a little further and pushed back into June. But certainly what we will be doing is making sure that all of our clients, if you're on our mailing list, are kept up to date as and when that is issued. So I think it's fair, sensible to actually look at what was within the proposed consultation document. And so the following slides I'll talk you through were the main points that arose from that. As I've mentioned on the slide, do note that these are all subject to change following the consultation period. It's likely that there will be some amendments, some clarification on one or two of the definitions that have been mentioned, So the following is just really to outline what the test looked like last year, but that is likely to change at some point in the future. So the test itself is actually divided into three parts. Part A will catch those who they consider to be conclusively non-resident. Part B for those who they see as conclusively resident. And Part C is the catch-all part effectively, and that's for those who are not covered by either Part A or Part B. So if we start looking at Part A and what points to conclusive non-residence, the document outlines that if an individual was non-resident in the UK in any of the previous 3 tax years and was present in the UK for fewer than 45 days, they would be non-resident. Or if you had an individual who was resident in the UK in one or more of the previous 3 tax years, if they are present in the UK for less than 10 days, then they will be non-resident. And finally, for those who are employed, if they spend less than 90 days in the UK but no more than 20 working days, they would be seen to be conclusively non-resident. On the flip side to that, Part B covers those who are conclusively resident. This will apply for any individual who spends more than 183 days in any one tax year in the UK, or if the individual's home, or if all of their homes, if more than one is in the UK, or if the individual carries out full-time work in the UK. So here we have a situation where there is much clarity that is required. The definition of what a person's home is, we still wait to hear from that. That could have quite a wide definition, but obviously the final detail should hopefully clarify that once and for all. Finally, moving on to the catch-all test, Part C, for those who are not covered by either Part A or Part B. Those individuals are effectively split between those who are considered arrivers and those who are considered leavers. An arriver is anyone who has been non-resident in the UK in any of the previous 3 years. A leaver is someone who has been resident in one or more of the three previous years. And then looking at those individuals, they then have to look at what connecting factors they have to the UK. The connecting factors that were outlined were where an individual's family is present in the UK, whether an individual has substantial UK employment or self-employment, whether an individual has accessible accommodation in the UK, whether an individual has spent 90 days or more in the UK in either of the previous 2 tax years, and whether an individual spends more days in the UK in a particular tax year than any other country. Dependent upon the number of connecting factors that a person has, they then produced a sliding scale of visits to the UK. So if it was 2 connecting factors to the UK, provided their visits remained within a particular level, they could be seen as non-resident. For 3 connecting factors, the level is then reduced. For 4 connecting factors, the level is reduced again. So it really is a matter of reviewing individual circumstances. So a lot of the case law parts that have been established does carry through to the statutory residence test. And hopefully you will see that whilst the idea of the test is to bring much more clarity, it's still likely to be a minefield. All the test is doing is pointing you in the direction of whether you are resident or non-resident. You still then obviously have to file your tax return or see if you need to file a tax return and plan your life overseas, understanding what the implications of non-residence are. So if we actually look at what the effect of non-residence is and why it's so important, generally if you're a UK resident then you're liable to UK tax on your worldwide income and gains. But if you're non-resident, it's only UK arising income that you need to consider. Also, dependent on the length of time that you've been outside of the UK, then there can be exemption from capital gains tax on the disposal of any asset, whether in the UK or worldwide. So if we look at a particular source of income that many people do have, and that's income from property. They may have property in the UK which they want to retain, but it can generate an income for you whilst you're living overseas. If you do that, obviously what you do need to consider is your obligation under the non-resident landlord scheme. Essentially under this scheme, if you have a letting agent, or if there isn't one, your tenant, they are obliged to deduct basic rate tax from the rents before they are paid over to you. That tax is then paid over to the revenue at the end of each quarter, and then you can claim that back by completing your tax return. However, if your circumstances and your tax affairs are up to date, it is possible to make an application to the revenue to have rents paid to you without tax being deducted at source, and that's just by completing a fairly straightforward form. The revenue will then write to your agent and say that they have details of you and that they don't need to deduct tax from the rents before they're paid over to you. Now that doesn't mean that the income you receive is tax-free. It simply means that there is no requirement for your agent to deduct tax, so you would still have to report everything on the end of year tax return if requested. Coming on to that subject, if you have tax returns issued, it is now more important than ever to make sure that these are completed on time. What the tax return will do is report the fact that you are non-resident and any remaining UK source income that you may have. Up until recently, whilst there was a penalty provision in place, even if you filed after the deadline, it wasn't of too much of a consequence to individuals. However, from last year, there's a new penalty provision that have been put in place, and a £100 penalty is automatically imposed and is payable if you miss the filing deadline, which, if doing electronically, is the 31st of January following the tax year end. If you continue to neglect to file your tax return, this can ultimately lead to daily penalties of £10 per day. There will also be interest on any late paid tax. We've found that the revenue for any debts are now passing these on to debt collection agencies as well, and they can also withdraw the approval under the non-resident landlord scheme as well. So it is very, very important to ensure that if you have ongoing obligations to the UK tax authorities, that you continue to ensure that these are met whilst living outside of the UK. So for that particular part of the webinar, in summary, the important things for you to look at whilst being overseas is to consider your resident status. If you've recently left, make sure that you've made a distinct break and that you can consider yourself to be non-resident. Do keep up to date with the implications of the statutory residence test. As I say, that will affect everybody living overseas. As soon as there is any word on that, we'll be making sure that all of our clients are kept up to date. But as with all of these things, it's very important to look at your personal circumstances with the test as a background to make sure you know exactly where you fit. Make sure that your tax compliance is up to date, so looking at non-resident landlord scheme, tax returns if issued. And if in any doubt, all of these areas are matters that within the Fry Group and the Fry Group Tax Department that we cover, that we're able to assist with, and we can deal with on a day-to-day basis. So that's the first part of the webinar over. I'll now be transferring over to my colleague Alison Lane. So there may be just a moment's silence, so if you just bear with me for a moment.
Hello. Oh, right, okie doke. Hello everybody, and this part of the webinar will be talking about overseas investing. Thank you very much, Dean, for your summary about key considerations when you're leaving the UK from a tax point of view. I think there's lots of things to take on board there, so it sounds like it's important to get some good advice from an expert, I think, to make sure that you're on the right track. Today I'm going to be giving a broad overview on overseas investing and looking at the different stages that you may well be in as far as your process as far as investing is concerned when you're overseas. What I'm actually going to be doing, if I can just move that across there, 1 second. Oh, sorry, just having a bit of a technical glitch there. Okay, So the things I'm going to be covering off today is just giving a brief summary about where we are at the moment. I think we're living in uncertain times, so it's just a point of just looking at some of the key considerations that a lot of clients are concerned about at the present time. Then what we're going to do is I've broken up the presentation into 3 different areas. So we've got different life stages that you need to think about, and different things you need to be concerned about depending on whereabouts you are. If you've just moved overseas, you may be looking at accumulating your wealth, so we'll be talking about ways in which we can do that. We'll then talk about ways of maintaining what you've actually built up and preserving the capital that you have built up while you have been overseas. We'll then talk about your decumulation years. So really this is looking at when you're retiring, and you may be retiring overseas, but you may decide that you want to retire and return back to the UK, which we do find quite a lot of clients that we speak to do decide that is what they want to end up doing. And then I'll just give a brief summary about what we do as well, so that you've got an idea of the process. It will be a broad overview, as I said, so some of these things may be quite basic, but it just gives you, we've got clients listening today from I think at least over 20 countries, so I just wanted to go through things from a generic sense. First of all, I found this fact fairly recently about longevity, and I don't know if anyone's seen this before, but apparently if you're alive today in the UK, you potentially 11 million of us can expect to live to 100, which I think is a startling fact. And I think it's important to bear that in mind, in the sense that a lot of us are living much longer, and whereas before we looked at retiring at 60 and 65 and maybe only living to say 70, 75 or 80, lots more people are living far longer now, and it's important to make sure you've got plans in place to cover, to pay for that long extended retirement and make sure it's as enjoyable as it possibly can be. So this brings me on to my first poll. And Sarah, if I can ask you to start that up for me.
Yes, yeah, no problem.
Excellent,
Okay.
thank you.
So you're now about to see the second poll on your screen, and the question is, have you saved enough for retirement? So please select the response that most accurately applies to you. Yes, no, or don't know. So I can see the votes are coming in now. That's great. Give you a few more seconds to get your response in. Very good. Okay, and I will now close the poll in 5, 4, 3, 2, 1. That's great. And you'll see the responses on your screen now, and they are 42% of people say that they don't know, 39% of people here today said no, and 19% say yes. Okay, Alison?
Excellent, thank you.
Great.
Okay, quite interesting figures actually. A company, Scottish Widows, have recently produced a study and just to assess whether or not people have saved enough for retirement, and they found that 46% weren't saving enough, and over a quarter of the people they polled aren't saving at all towards their retirement. So there's a huge savings gap there, which is something that is a concern for future generations. So interesting facts there. Thank you for responding to that. So where are we now? I think we're all reading about different things in the papers. I've got the front page of the Financial Times today is talking about Spain and Italy, and there's concerns there. So at the moment we're living in an uncertain economic climate. Having said that, there is uncertainty in the markets, but one thing that we have found is that there are certain stocks out there which are considerably undervalued compared to their average price, so that there's definitely some movement there as far as equities are concerned for certain companies moving forward. So definitely living in uncertain times, but I think moving forward it'll certainly be some good opportunities there from an investment point of view. As I mentioned before, people are living longer, and it's important to make sure that you've got savings in place to cover your extended retirement, and if you decide to carry on working, just making sure that you're topping that need up. And within that backdrop, people are living longer, but we have found in the UK and across Europe and a number of other countries, a lot of people found that they were benefiting from very generous pension schemes from their companies, and that seems to be reducing substantially, particularly in the UK and Europe. And across the world, I think, in that people can't really rely on their companies to support them in retirement anymore, so it's important to be able to make sure you've got your own provision. So what I'm going to do now is just talk about some of the key things you can think about depending on whereabouts you are in your life. First of all, a lot of the clients I speak to, when they do decide to move abroad, their main reasons for moving abroad is normally financial. So depending on where you are, we've got quite a few people at the moment moving abroad because there's definitely increasing career opportunities, and potentially the pay's a lot better as well. So I speak to a lot of people, and the first thing they look at doing is paying off their credit cards and short-term debts just to make sure everything's clear. And then they do tend to find that they've got a lot of surplus income, and it's important to look at utilising that surplus income so that it doesn't get wasted. So what we're tending to do for a lot of people is look at setting up regular investment accounts, which can be offshore. They can be in multi-currencies, so depending on where you are, if you want to save in dollars or if you want to save in euros or pounds, you can save in a number of different currencies, and it's very flexible as well, so that you can increase or decrease payments as well. And it just means you can then see something building up for later on, which is always a nice feeling. We do get some clients who say that they're looking at saving it for a particular purpose. It could be if you've got children that you're wanting to save for their private education, or it might be that you want to save towards their university fees, and we can help with that as well. We've got a lot of clients also that are looking at maybe saving for an additional home, either now or in retirement, and again, some of these regular investment accounts can help with that as well at the same time. And we've already mentioned retirement, which is another key area people can save towards. What we've developed is we've developed a number of different calculators that can help with that need, and what we can do is we can, if you've got an idea of how much surplus income you've got and how long you want to save for, we can give you an idea of what type of pot that will build up. Equally, if you feel that you want to save a set amount, what we can do is we can look at saying to you, well, you need to save maybe this amount per month over this period, and that will give you a good gauge to see whether or not you're on track or not. Then we come to the maintenance years. So hopefully now you've repaid all your debts. You've started to build up a nice pot of money in various different ways. And it's important now to look at maintaining what you've saved, and also looking at saving in a very tax efficient way as well, if possible. Now, as I said before, we've got people listening today from over 20 countries, so there are lots of different rules in lots of different jurisdictions, but we do offer advice we've got different types of investments that can be beneficial in different areas depending on where you're based. For example, if you're based in France, there is a particular type of investment which comes under the Assurance V rules, which can be very beneficial depending on your circumstances, obviously, in that any type of profit that comes from that particular investment is taxed in a very tax efficient way. The tax is reduced down the longer you've held it for, and it can be very beneficial and a good way of building a very tax efficient pot for you. There are also lots of other different things you can look at doing as well. We have clients that like to invest in offshore bonds, and particularly if you're planning on coming back to the UK, depending on your circumstances, that can also be a good way of saving, because you get a special relief for the amount of years you've been abroad, so that when you then come back to the UK, the amount you've saved up whilst you're abroad won't be taken into account from a tax point of view. So again, I'm happy to speak to anyone about that in a bit more detail if they'd like. So I think in the maintenance years as well, we do speak to a lot of people that may have had a spell abroad, and I'll talk about this in a bit more detail in a moment, but it's maybe looking at trying to simplify your savings so that you're running them and they're just carrying on, rather than they're controlling your life, if that makes sense, if you're getting lots and lots of different statements coming in. And it's important to review those investments as often as possible as well. I've mentioned cure-ops at the bottom, and I will talk about that in a bit more detail. I don't know if anyone's familiar with the term or not, but it's something I get a lot of clients asking me about, so I'm going to talk about that again in a slide further on. Okay, so in essence, cure-ops. It stands for Qualifying Registered Overseas Pension. And what's happened, there's been a number of changes. To give you a bit of a historical notice about it, what happened is that the European Union a number of years ago said that the UK had to introduce legislation so that if you were moving abroad, you were allowed to move your UK pension abroad with you. because they felt that particularly there must be a number of people here that have decided to live abroad permanently, and they felt it wasn't very fair that people would have to just leave their pension in the UK whilst they're going to be permanently moving to another country permanently. So they introduced this legislation, and what it meant was that you could move your UK pension to different jurisdictions, wherever that might be, and there were lots of tax benefits of doing that as well. So for example, it still grew tax-free, but there was the ability to have tax-free income, and also there were some jurisdictions that let you cash in the pension as well at the same time. Since there was then a consultation which took place over the last few months, really, mainly during most of last year, and during that consultation process the government got concerned that the rules that they introduced weren't actually being adhered to. So what they felt was that the spirit of the legislation, I should say, wasn't being adhered to. So the reason, what they wanted is they said, well, if you're going to move to, say, Brazil, and you want to move your pension to Brazil with you so that you can change the currency and keep it there forever, that's no issue. What they didn't like is what seemed to be happening is they had lots of people moving their UK pension rights to tax havens such as Guernsey or the Isle of Man, wherever it might be, and what they were doing is they were taking a tax-free income from that pension, whereas normally if it stayed in the UK it would be taxable, and some of them were also cashing in the whole lot as well, and the government wasn't very happy about that. So what happened on the 6th of April is the government introduced brand new legislation to change some of that so that the rules were stricter. So in essence what the government has said is that if you want to move your UK pension abroad, that's fine. However, you can't move it to a third country. So in other words, if you're moving to France and you want to potentially move your pension to France because you want it to be denominated in euros, that's fine, but you can't start moving it to Guernsey or Isle of Man or something along those kind of lines because they can't see any kind of real benefit from it. So there's a number of different changes there. The government also said they're not very happy with people receiving tax-free payments and for the actual income that they may get when they retire, and they've put a stop to schemes that provide that as well. And there also were a few schemes that were letting you have more than your 25% tax-free lump sum, and they've put a stop to that at the same time. So they have tightened up on the rules. What I would say at the moment is that they've introduced these new rules, but there is still a bit of a grey area surrounding it at the moment. We have had a lot of inquiries about it because I've got a lot of clients saying, I've got a couple of UK pensions, I'm now living in Spain, I want to look at consolidating them and moving them abroad. When can I do this? What I would say is that every single person is different, so it's important that if you do think this is something you would like to do, if you give me a call, we can talk about your individual circumstances because it could be of benefit to you, but we just need to find out exactly why you want to do it and just to look at that, because there would be costs involved in doing it, so we just need to make sure that it would be something that would benefit you rather than just incur those costs for no reason. So happy to talk to anyone about that if they would like. Okay, so in your maintenance years, what you will find is that, particularly if you've been abroad, you may have built up lots of different pots from all over the place. So you're at the centre of this, and you may have some ISAs that you had when you were in the UK, and you may have some UK pensions that you privately paid into when you were working. You may have lots of other different types of investments as well, properties, individual shares, and it's important to make sure you can monitor and see exactly what you've got and make sure that you're still on track as well, because I find that often we speak to people and they might be moving from place to place, so you may end up getting statements sent to one of your old addresses, and sometimes it's difficult to keep track of everything. We do have a service whereby we can do that for you if you'd like, and I'm happy to speak to somebody if they want to, just so that they can get a bit more information about that. Okay, so now we come to the best bit, your decumulation years, and this is really when you're in retirement, and it's all about utilising what you've built up at this stage. So really just taking a step back and looking at the pot you've built up and making sure that it's going to be adequate for your needs, working out what kind of income you'll need. There's lots of different changes to, if you do still have a UK pension, there are lots of different rules and regulations that have recently been introduced about taking your benefits. It's become a lot more flexible. Years ago, you used to go down a traditional route of purchasing what was called an annuity, which is an income for life. Over the last few years, there have been far more beneficial options available, potentially, depending on your circumstances. If you have health issues, you can look at taking out what's called an impaired life annuity, which means that you get an enhanced income because you may potentially have a reduced life expectancy. There's also ways in which you can take down a flexible amount of income from your pension pot, which can be beneficial from an inheritance tax point of view, and leave the rest of it invested in the pension. So again, it might be, you might want to talk to somebody about that. So the capped and flexible was just really mentioning the fact that you can take down a fixed amount if you want to, or you can take down a flexible amount of income as well. So happy to talk about that to anybody. Finally, I am going to mention a little bit about inheritance tax, because a few people that have registered said that this was a concern. And as you probably know, if you are still a UK domicile, you will still be liable for UK inheritance tax on your worldwide assets. So even if you've been abroad for a number of years, it could still be an issue for you. It's very difficult to change your domicile, but I know Dean can talk to you if you need any assistance with maybe looking and seeing if there's a way that you can do that. So with regards to inheritance tax, I thought I'd just run through the key points, which you may or may not know. It's quite the basic key points, really. So at the moment, the current rate of inheritance tax is 40%, and that's charged on anything over your kind of nil rate band, which is, so in other words, if you're an individual person, you have £325,000, which is your nil rate bound allowance. If your estate is worth more than that, anything over and above that is taxed at 40%. You can transfer money between, if you're married and you're both UK domiciled, you can transfer funds between each other, and that is exempt. Or however, if your wife or husband or partner is not UK domiciled, then you are limited to how much you can transfer across. So just need to bear that in mind. So the other thing to bear in mind is you have an annual exemption, which is £3,000, which you can gift if you want to as well. And there are lots of different solutions out there. So if it is a concern and you think your estate is worth more than £325,000 individually, or £650 if you're married or in a civil partnership, there are lots of different things you can look at, a whole host of different things. I won't go through them in a lot of detail now, but we can look at setting up investments where they are partially exempt straight away, or we can look at ones whereby they are partially exempt after 7 years. We can look at setting up trusts. There are lots of different options available to you. So just to give you the brief principle of how the inheritance tax is calculated, a very basic calculation. If you had £1 million worth of investments and £500,000 worth of properties, then you've got a £1.5 million estate. And if you take your nil rate band out, so that's for a couple, then that would leave you with a taxable estate of £150,000, which means you've got an inheritance tax liability of £340,000. So quite a substantial amount, and it is something you can plan to reduce if you would like to. So now I'm just going to talk about a little bit about what we do. As far as the financial planning at Fry's is concerned, what we need to do first of all is find out as much about you as possible, and we do that by having an initial first meeting either face-to-face or on the telephone. From that, because everybody is different, we need to find out about your individual circumstances. Everybody is different, and depending on the assets you hold will depend on the sort of advice we give you, because there could be tax implications. If you've got children, you may want to plan in a slightly different way. And also, we do have a lot of people that have been married more than once, and they may want to make separate provisions for, say, for example, children from their first marriage compared to the second marriage, for example. So it's important to have as much background information about your circumstances as possible, and then what we can do is we can plan accordingly. So once we've had that initial discussion, which is free and at our expense, so you don't have to pay for that initial discussion, what we will then do is establish what you need to do and then what you would aspire to do via your goals and needs, and we can look at building a plan in place. Depending on what you want to do, if you do want to look at investments, We will then need to assess your attitude to risk, which I'll talk about in a moment in a little bit more detail. And then from that, we'll then look at building a plan in place. So if it is lump sum investments you want to look at or regular savings, we can build a plan in place over the next 5 years and then possibly look at longer if you'd like to as well. If you have concerns about things like making sure you've protected your dependents if something was to happen to you, we can look at things like life cover. So we'll build that plan so it's suitable for you, and we'll then, most important thing is to regularly review that plan. We recommend reviewing it at least every year, but it's completely flexible. Some clients want to review it every few years, some clients want to review it every 6 months. Everyone's different. So talking about risk, some people may have seen something similar to this before. Literally all it's doing is it's showing you the different levels of risk and the type of reward that you may have. So at the moment we look at risk and divide it into these different areas. So depending on where you invest, if you invest in the minimum area, you're investing in cash. It's potentially there's no risk to your capital falling in value. However, there is a risk that it may not keep pace with inflation. So it's important to make sure that particularly in Europe at the moment, there's a distinct inflationary risk that you're investing your money so that it does at least keep pace with inflation moving forward, so that it keeps its purchasing power over the next few years. And then as you move up the spectrum, you can look at investing in different assets. So we're getting a lot of people at the moment are investing in things like the low risk area potentially, because they're nervous about the markets, and so they are increasing in value. Some people feel that those low risk assets are potentially overvalued, so they're looking at potentially increasing the amount of risk they take in their portfolio, but it will be completely down to individual circumstances. So in essence, the more risk you take, ideally the better the potential return, but also you have got increasing volatility. In other words, the value of your investment can go down as well as up. So just important, what we do is we assess where you feel comfortable sitting on that spectrum, and then what we will do is look at building a balanced portfolio for you. So in that portfolio we'd have a whole range of different assets depending on your needs. The yellow slice, which doesn't look very easy to read, is property. I'm not sure if that was the best colour to choose for that one. So really it's important to have a mixture of assets in your portfolio, and what we tend to do is we tend to recommend managed type funds, but we have a special company that rate those for us according to different skills and what have you. So it's important to make sure that you have a balanced portfolio, because you will find these different assets some of them will rise when others fall and so forth. So it's important to make sure you've got a good mix there, and we can certainly help with that. So finally, one thing we do have more and more clients wanting to do is, we talked about the fact earlier that we've got people that have got things all over the place. And quite often, if you've been working for a number of years, you may well have built up a whole range of different types of pots, if that makes sense. So it may well be that you've got direct shareholdings. It may well be that you've got bonds, which may be offshore or onshore. You may have cash savings accounts or pension pots from both in the UK and abroad as well. And what we are able to do, if you'd like, is we do have systems in place whereby we can look at centralising all the paperwork for everything that you have. It means what you would have is you would have online access to your whole portfolio of everything you've built up, so that you can actually view everything you've got and just to see where you are and to make sure you're on track. It does make changes easier as well. So for example, if you've got this all in one place and we decide that you want to maybe take more risk or less risk, we can change things more swiftly, as opposed to having to write out to all the individual companies and remembering where everyone is. So we do have that in place. A lot of people find it makes things a lot easier. And it's important to have, it's nice to have these different tax wrappers as well, because they all have different benefits. So it makes life easier for you, but then you can benefit from the different tax benefits within that as well. So that's pretty much all from me. As I said, just a generic overview really, just to give you an idea about the sort of things we can talk about, and I'm happy to talk about that in a bit more detail to anyone individually. And what I will now do is I'm now going to hand over to Dean, who is just going to talk about going back to the UK. If you just bear with me for 1 second. Over to you, Dean.
Thanks ever so much there, Alison. Plenty to think about there. Some very, very useful points, I think. Again, it highlights the fact that there isn't necessarily a one-size-fits-all solution for people. It is very much the case that you need to look at your individual circumstances and actually try to ascertain exactly what you need to be doing. Just trying to get the presentation going again. There we are. Returning to the UK tax system, it's obviously a vital time for planning. And here again, there is no particular advice that fits everyone. So again, personal advice is an absolute must. What I'm going to do is just highlight the general areas that you should be looking at reviewing, although the specific action for those points will be very much dependent upon individual circumstances. So certainly what you need to have clear in your mind when you're returning to the UK is your date of arrival, any employment payments that you're entitled to, your existing investments, any property that you've accumulated, and also after you've returned, what planning you can do following on from that. Starting at the very beginning, the starting point should always be when you intend to return to the UK. Now technically, as far as tax purposes are concerned, you're either resident or non-resident for an entire tax year. However, it is possible to split the tax year of arrival into a non-resident part and a resident part for income tax purposes. Now this is by concession, which is just a relaxation of the normal tax rules. Technically that concession could be withdrawn. Personally I haven't seen it, but as a case that I wanted to highlight will actually show the revenue do still take an interest in you as and when you're coming back to the UK. And the actual case is surrounding a gentleman by the name of Rupert Kimber, and it's all to do with the point that he became classed as resident in the UK. He was actually found to be resident here when he was actually here on holiday, and as a result of that he was left with a rather substantial capital gains tax liability. The brief background to the case is that Mr. Kimber lived and worked overseas in Japan since 1997. At the beginning of 2005 he decided that he wanted to make a return to the UK, so he started to look for alternative employment. In May 2005 he booked a family holiday, and that was planned from the 17th of July 2005 through to the 30th of July 2005. After that point he had a foreign holiday subsequently planned to that. After that foreign holiday he arrived in the UK on the 28th of August 2005, and it was at that point that he then went to the Revenue and said, I'm now here, I'm a UK resident. Following an investigation by the Revenue, they actually found him to be resident from the earlier point on the 17th of July 2005 when he arrived here on holiday. When I first read this case, the headlines that it produced was quite sensationalist. But when you actually started to read through the detail, you could actually understand why that particular opinion was reached. So he arrived on the 17th of July. The week before he took steps to actually join a UK company. Prior to his arrival here, he had also handed in his notice to his Japanese employer and had made arrangements for the family belongings to be brought back to the UK. Whilst he was here on holiday, the children were enrolled in UK education, and for an existing property that he had here, it incurred in a significant amount of expenditure, and he'd also set up a new tenancy on a rented property. The important point here is that after he left on his holiday and was claiming to still be non-resident, he actually made a disposal of some shares related to his Japanese employment, and the capital gains tax liability from that was just over £96,000. So it's not difficult to see why the Revenue were interested and wanted to treat him as resident from the earlier point. So when you look at what he had actually done, it's actually quite understandable why the decision was reached. It's important that obviously you'll be making plans to relocate your family, belongings and everything like that back to the UK, but what you should ensure is that those actions do not see you being treated as resident from an earlier point from when you actually intend to report yourself as resident. Here again, it actually highlights the fact that professional advice on this particular point is very, very important. So looking at some of the other areas that you would need to clarify in your own mind, if you're employed outside of the UK and returning to the UK, do make yourself aware of when your overseas employment will actually come to an end, when your contract will come to an end. Also highlight with your employer if you're due any particular payment at the end of your employment with them. So that would include your salary, any particular lump sum payment or ex gratia payment that may be due to you. If you're entitled to any form of bonuses, do make yourself aware as and when they will be payable. And if you've accumulated share options overseas, that's also another area where specific tax advice would be necessary. Again, the timing of those sorts of payments are very, very important. Again, linked with your personal circumstances, the actual advice as to what you should be doing with those will be very much dependent upon those circumstances. Looking at your investments, certainly it's a good time to review what you have. The investments may indeed be very different from the time you originally left the UK. So again, try to ascertain exactly what you have, which ones are showing gains, which ones are showing losses, and look at taking any particular action with those. These sorts of areas would include any bank accounts that you have either in the UK or overseas, any shareholdings, any bonds or investment wrappers that you may have invested into. Also do make yourself aware that whilst your investment portfolio may have been built up whilst you're non-resident, that may have been very tax efficient for you at that time. When you actually come back to the UK, it could be that a movement in the actual investments are sensible because it may simply not be relevant for you as a UK resident. So again, it's probably an area where particular advice would be needed, certainly to plan if you're coming back to the UK for retirement, for example, providing for income in retirement, or if you're just looking to put as much money away as possible, again, the advice would be very different. If you have UK property, you may very well be aware of the idea that a person's principal private residence is exempt from capital gains tax. However, what isn't so well known is the actual definition of a principal residence. We do come across many clients who may have acquired property whilst overseas and believe that as it's the only property in the UK, that would be considered exempt from capital gains tax. Unfortunately, that isn't the case. As I've said on the slide, mere ownership isn't enough. The property must actually be your only property that has actually been lived in as such. So if you had property that you lived in before you moved overseas, there's likely to be some form of exemption on that, although not automatically for the entire period. If you purchase property since living overseas, you really do need to make yourself aware of the potential capital gains tax situation on that. Currently in the UK, capital gains tax are taxed either at 18% for basic rate taxpayers, or if the gain takes you into higher rates, then that will be 28% that you then pay capital gains on. So it's a point that is often overlooked, so certainly very important to make yourself aware of any action prior to your arrival in the UK. When you are back in the UK, it's a time that you can also then look at tax planning. Once you've made yourself aware of your liabilities, you can then start to look at the asset spread between yourself and your spouse or partner. If one of you is a higher rate taxpayer, then obviously it could be sensible looking at transferring some assets to the lower rate spouse in order to take advantage of the lower tax rates. It's often the case that all investments could be just in one name, and the spouse may not be making use of their full personal allowance. So it makes very, very sound advice to actually review this and look at spreading assets around if possible. Again, you may even look at investing for capital growth rather than income. Again, this is all dependent upon your individual circumstances. When you are back in the UK, it's then possible to look at investing into ISAs again, obviously very tax efficient. You can also look at investing into enterprise investment schemes, which are very tax efficient, again dependent upon your investment attitude to risk and also your personal circumstances, but they're certainly well worth reviewing. Also look at anything else that attracts tax relief, such as your pension contributions and also charitable donations as well. All of these areas, if you are a higher rate taxpayer, can go towards actually taking you out of the highest rates of tax in the UK. So as I say, it's very difficult to provide specific advice on returning to the UK, as it is so particular based upon your circumstances. If you are looking at taking up employment after your arrival, you will still need to then look at making sure the correct pay-as-you-earn tax code is put in place against your income. Returning to the UK gives you a good opportunity of taking stock and reviewing any will that you may have written. Again, your assets at the time may be very different from the time that you actually originally wrote your will, so it's a good opportunity to revisit that part as well. And also do consider that this is obviously aimed at UK tax implications. Whilst action may be sensible as far as the UK is concerned, do make yourself aware of any local advice that you may need to make sure that you're not opening yourself up for a particular tax charge in the country of residence. Here again, it's a service that which we are able to provide for our clients on a day-to-day basis. It's something that we deal with. We have a specific service aimed at individuals returning to the UK, which highlights all of the areas that I've covered and that we are able to advise you on and make sure that we see you back into the UK tax system efficiently, quickly, and also can then deal with any subsequent matters following your arrival. So I'll just leave you with that regulatory notice as well, just to take account of as well. I've noticed that there's been a good lot of questions coming through on the webinar, which is really, really good to see. Sarah?
Oh, should we run through some of them, or?
Well, yeah, absolutely,
yeah.
we can do. Yeah, that's fine. That's no trouble.
Yeah.
Have you got one over there, Alison?
Oh, Dean, I've got one. Oh dear, sorry, I thought I was going to knock something down there. Dean, I've got one here actually. If I don't know if I've got one person that's saying which country should my UK employer's pension be declared for income tax? I'm resident in France for tax purposes. Do I have a choice of French or UK tax?
Yeah, essentially there is. Again, it's one of these things, as with tax, there isn't necessarily a straightforward answer. There's a double taxation agreement in place between the UK and France, and this would determine how the pension would be taxed. Again, it would depend upon whether the pension is considered a government or a non-government pension, but dependent on that answer, you could well have the pension taxed in France as opposed to the UK, although you'd need to complete some paperwork with the UK tax authorities, so they could put a no tax code in place against a pension, and you then simply report that to the French authorities. Alison, one for you. We've got one here. I've just moved out to Dubai and I have a personal pension I set up whilst living in the UK. Can I still pay into it?
That's a good question. It depends really. If you've literally just moved out to Dubai and you do want to carry on making payments into it, if you need to, if you've still got earnings in the UK, then you can still pay up to 100% of those earnings. But however, if you don't, and all your earnings are in Dubai now, which is probably the case, then you can still pay into it, as long as you set it up before you left and were contributing to it before you left, for up to 5 years. But the maximum you can pay in, you physically can pay in, is 2,808 per year. And what happens is the government will give you tax relief to make that up to 3,600. So it's only for the first 5 years, and you have to keep in that scheme that you originally set up. You can't say move it to another pension scheme or set up a new pension scheme. It has to be the one that you set up whilst you were in the UK. But yes, that is something you could potentially look at doing. Dean, over to you, if I can just see if there's any questions here. I've got one here. There's a person selling property in Europe. What are the implications of selling both before and after returning to the UK? Because they're not sure when they should time the sale.
Yeah, absolutely. And as I mentioned, timing is very, very important in everything when planning a return to the UK. I mentioned the Principal Private Residence Rules, PPR relief, and they do apply to property outside of the UK also. So the history of the property would be important to establish. Dependent on the length of time that you've lived outside of the UK, it may make sense to sell before you arrive in the UK. You may be exempt from UK capital gains tax. That's actually related to another question that I did notice somebody asked about how long they have to be outside of the UK in order to be exempt. The answer to that is that you're outside of the UK for 5 complete tax years. Once you've gone over that point, you're exempt from capital gains tax up until the point that you arrive in the UK. Going back to the property in Europe, if you sell after arrival in the UK, you then become liable to worldwide tax on a worldwide income and gains. So potentially there could be some some liability on the property, but it really does depend upon the history of the property, when that was occupied, purchased, and that sort of thing as well. So again, hopefully that's given a general idea of the potential answers to that. I've noticed quite a few questions coming in actually, Alison, which are asking what people should be investing in at the moment. Perhaps that's $1 million question. What should we be doing?
Well, it is $1 million question, I think, at the moment. I think everyone's different, and going back to the presentation, what we need to do is to look at your level of risk you feel comfortable taking, because there are certainly some interesting assets out there that are certainly a lot of commentators feel are undervalued. There are lots of equities out there that are trading at far lower prices than they were, say, 2 or 3 years ago. So there's definitely some value there. And particularly there's a lot of companies in the UK, for example, whereby they've got a lot of cash and they're starting to pay really good dividends as well. So there's a lot of funds that are paying really good income. I won't be able to give a specific thing. I think everyone's different, and it's really just a case of running through how comfortable you are, what kind of timescales you've got. If you're looking at something short term, it would be looking at something different, and something longer term, then again it would be different again. So there's definitely some interesting things out there. I think there's definitely some good opportunities out there, definitely. So happy to speak to anyone individually about that, Dean.
Marvellous. There's quite clearly, perhaps we've just got time for just one other question. As was mentioned earlier, I can see that there's a whole ream of questions come through, which is fantastic. We will have copies of those, and we'll look at getting in touch and responding to you all individually after the webinar. So don't worry if we don't cover your question now. The one that I picked up on was about somebody has a spouse in the UK who's UK resident, but they're not. They hold a joint bank account that's held within the UK, and the question was, if his employer pays the salary into the account from abroad, is it taxable? Well, I mean, certainly providing all of the duties of that employment is conducted outside of the UK, even if the salary is paid to the UK tax account, UK account, there will be no liability. The only point that there would be tax to consider is interest rising on the account, which probably the best said about bank interest rates at the moment, the better. Probably not that exciting. So I think we're just about at the top of our hour there, Sarah.
I think we are. Are we, Sarah?
Yes, that's right. Yeah, that's right. Yeah, we've just reached the full, just slightly over the full hour now, so that's fantastic. So we'll wrap things up then. Thank you very much, Dean and Alison from the Fry Group, for sharing the benefit of your experience with us today. Thank you too to the attendees for your participation in the event. We would appreciate if you could take a moment to complete the very short survey you'll see as you exit the live session. As we have mentioned, you will all receive a copy of the recording. So with that, I will end the webinar.
Thank you. Bye.
Thanks so much.
The organizer has